Cool. Okay. So start the recording. Let's go ahead and break this down. All right. So AVPT, you want to see where it's going, and you said you want to do a cover call, right? Or see if you wanted to, if that's a good move
Yes,
for
right.
you. Okay. Let me reset all of this. All right. Man, can't believe I'm still looking at this one. This we traded this one a long time ago when it was called something else at first, but they had to change the name because of Jeffrey Epstein. Jeffrey Epstein was the CEO of the first, or I guess the blank check company. That's actually how we got our name, not from Jeffrey Epstein, but from blank check companies. That's their way to bring the company to the market. But okay, all right. So AVPT, let's see, it's been climbing up. Let's see, RSI is at what 65 on the day. Let's look out a little bit further. And you wanted to do cover calls. So with cover calls, you're holding over 100 shares or more, right? If you're doing it like you want to sell contracts, is that right?
That's right. And yes.
Well, I mean, yeah, it's nothing to be ashamed about holding 100 shares or more now that is up. If we would have talked if
Right.
we would have talked with you a year ago, it'd be a different conversation,
Mhm.
but it's starting to
Mhm.
come up. Okay. So looking at it now, looking at it on the week, we can see that it's going into this gap on the VRVP as far as volume. Um, and it looks like right where it's sitting at, it actually has resistance right around 12 to 1250. It looks like it'll start to slow a little bit. The next level that we can see it at is about 1450 to $15, I would say, up in this level here. And then if things get really, really crazy, we can get up to about 16 to $17 is what I'm looking at. And this could be making a cup and handle, which a cup and handle, it the cup part is already formed. The handle will come back down. The only thing about a handle when you're forming a cup and handle is that it cannot break below 50% of the cup. So if we start here at 12 bucks and the bottom of the cup is here at what $4, we need it to hold above about $7, $8. So if it go below, if it pulls back, but it does not go below $8, then it's forming a cup and handle for you, meaning it's going to go back up. And it could be an opportunity to buy the dip on it. So right now, on the week, RSI, of course, is high at 74 because it's been climbing a lot. The MACD is crossed over to the upside, but the stochastics is showing that it still has a little bit more space to go. It's at 74 out of 100. It could go all the way back up to 100, and it has the momentum to move up. I'm not sure. I haven't been reading up on this one again. I haven't heard of this stock for years. Um, what happened? What was the catalyst to send them up? They had a deal. I mean, been doing all right with earnings. I know they had a deal with Microsoft a while back, but do you know why they've been moving like this?
No, I just happened to start looking and just seeing that the volatility of it continuing to move up. And so um just been kind of watching it from that point, but not like researching as to why.
Gotcha, gotcha. Let me see. Trade development. Hmm. Okay. Don't know why this one is. I'll have to do some research on why this one is moving. But it's been moving for a while. It started moving back in June. Actually, it moved before that. It was consolidating. Ooh, this is what May. Yeah. Okay. It started moving in May. The earnings in May set it off. Okay. I'm just trying to figure. Okay, and then it ran from this earnings to this earnings. That earnings, it had a pullback and then it kept running. So it looks like we may continue to run into earnings, but we also may have a pullback. So what I would be looking for right now, since I can see that it tested this $12 mark twice, on these two candles and then it pulled back, we could be coming back down to about $11 to 11.25. So anywhere around uh, okay, I'm pressing the wrong hotkey, but anywhere around this level, because it has a lot of support right there. So if you're looking at doing covered calls, what I would do is, so covered calls, the strategy with covered calls is that you're pretty much playing keep away, right? So let's set a call up. Sorry, letting Lisa in. You want to set a call up that's close enough for people to buy it, but far out enough to where it won't be exercised, right? So for instance, if you set is that what, 11.75? If you did a $12 call, you may get exercised on because it could pop back up to $12 real quick, and then somebody could exercise the call. What I will look at is when it pulls back down and it gets ready to go up. So let's say when it pulls back, this is the strategy I'm looking at. If it pulls back down to about 11.25, which if it pulls back 50 cents to 75 cents back to the base, I would be looking at a $12 call to a 12. Actually, I would do a 12 to between a 12 and a $13 call. If you do a $12 call, you probably will make more money. The good thing is that if you get exercised on, the only thing that's going to happen is they take the shares, but you take the money. So, there's really no loss. You'll just be out of the trade. But, oh, someone had a question? Oh, I thought Michelle said something. Okay. But yeah, I would be looking at a $12 to $13 call. I wouldn't stretch it out too far. I don't know if you wanted to play like a weekly or if you wanted to play it monthly, but I would be looking at 2 weeks to maybe 3 weeks. I don't know what the option spread looks like to see if they have options that expire every week, but that's what I would be looking at. And I would try to play it on a pullback. Since this thing is moving so fast, you don't want to set it too close to where they can actually exercise it. Again, we want to play a game of keep away. So once it pulls back, because it looks like it's going to start pulling back at some point. Once you see it down, you can set your alert too. You can set an alert for what, 11.25, and then you can set another alert for like $11 even. Once that alert triggers, then you can start looking at setting up that play that you want to set up. Again, $12 would get you more, but it's a little bit more risky because you could get exercised on. $13, I don't think that it would just jump from $11 to $13 in a week or two, unless you got earnings. Now, if it's earnings coming up, it's a coin toss. Anything can happen. But that's what I see looking at a point. Any questions,
Okay,
Michelle?
and that's looking at a 2-week time frame. You were saying from like whenever I started, like kind of tentatively 2 weeks.
Right. Yeah, I would be looking at 2 weeks because the only thing is like if you get in and you stay in too long, like if you stretch the contract out for too long, you're giving them ample opportunity to exercise on you, and the stock is already moving up. So you just want to be in and be out, right? You don't want to give them a chance to actually catch you in the act of trying to get away with the money. Right.
Okay. Thank you.
Any other questions?
Nope.
Cool. All righty. I see that Lisa and Ty just joined in. Did you all have any questions before I got into what it was that we're going to talk about for today?
No.
Cool. Lisa, anything? Or she may not be at her mic. Silence is a thumbs up in my book. All right, cool.
The only thing is, I know you posted about the Microsoft sort of
Yep.
like as being like an option or a swing. Maybe we could use that as an example, just to learn more about that.
And I'm having tech issues, but me and Ty are in the same room, so I'm okay on questions right now. I'm just listening. Thank you.
Perfect. Okay, yeah. So we can use Microsoft as an example. So Ty and Lisa, you all probably missed it, but I do have an agenda written up. I'll be posting it in not an agenda, but a layout for the next 9 weeks. So I posted a portion of it in the chat, but I'm restricted by character, so there's only so many characters I can post in the chat. But we do have 9 weeks of different things that we'll be going over. I'll post the whole list. We have learning outcomes and key concepts for each one. A few of the things that we'll be talking about is the first thing, of course, is just going to be intro to stock options, calls, puts, strike price, expiration date, so on and so forth. Week 2, we'll be talking about option pricing as far as Greeks, intrinsic, extrinsic value, deltas, so on and so forth. Week 3, we'll be talking about covered calls, which Michelle and I, we were just setting up a covered call for her there. We'll also talk about cash secured puts. Week 4, we'll talk about vertical spreads, bull calls, bear puts. That should get interesting. And then week 5, we're going to be talking about credit spreads. So debit and credit spreads are very, very interesting, especially when you get into what it is and how you set it up and what you pick. I've tried a few of them. I'm not a big fan of them, but I think that just exploring the different options that you all have when it comes to options would be good. And then you can pick what you like and leave what you don't. All right, week 6, we'll talk about iron condors and iron butterflies. I know for people who watch earnings, you'll hear a lot of I know I read a lot of articles about earnings when it gets close for large companies. They talk about iron condors and iron butterflies. So those are like non-directional strategies or range-bound strategies. We'll talk about that. Week 7, we'll talk about straddles and strangles. Week 8, we'll talk about options, like how they expire, how to roll them, so on and so forth. Week 9, then we'll talk about advanced option strategies and risk management. So a lot of stuff to cover. Everything will be recorded. So if you do miss something, it kind of sucks. You don't get to ask all the questions you want to ask, but you can ask them, in a one-on-one if you want to set that up, or inside of the Discord. And I think we'll be doing a bonus week as well, to where I can do some live trading and we can do some strategy review. So, if you try any strategies between week, 2 and 9, and you want to review it to see how it worked, like you bought an option, week 2 and you cash it out week 7 and you just want to review it, we can do it then. But then I'll be doing some live trading, some live option trading as well. That way y'all can see exactly how I do stuff, and then you can figure out how you want to do it as well. But I have all of this written down here or typed up, and I'll be posting it in the Discord and changing the titles for all of the events as far as the event calendar moving forward. Cool. Any questions? Again, silence is a thumbs up. You don't have to say anything. All righty. All right. So what we'll do is we'll do an introduction with options. We'll use Microsoft. Microsoft is actually looking great. Had a really, really nice day. And we could see it moving a little bit higher to about 430, between 430 and 440 is what I got it going for. But all right, so let's talk about calls and puts first. All right, what is a call and what is a put? Let me bring up my Investopedia, which if you need to find, if you want to know any, if I'm saying anything, or if you see someone on TV or on the internet saying anything about stocks, just go to Investopedia and type it in. They have articles on everything you can think of, and even stuff you can't think of. Let's look at calls. I want to bring this article up. Calls and puts. I don't want the. Boom, there we go. That's the one I want. All right. And I'm gonna give you all this link as well. So this is the essential option trading guide by Investopedia. Pretty good. It generates a lot of questions on how to set things up and how you want them to work. Still pretty straightforward though. 1 second. Where am I? There we go. Okay, let me share my screen again. Bingo. All right. The link is there. All right, so this is pretty much a guide to just the basics of options. So if you want to know what are options, you can read all of this, but I can just tell you what an option is. So an option is pretty much a contract that you can use to, you're not, I want to stop using the word option while I explain the options, but it's kind of hard. But an option is basically a contract that gives you the right, but not the obligation to buy or sell an asset that you don't own. Like, you don't have to own it. You can own it, but you don't have to. So for instance, if you wanted to buy a call, and what is a call? A call is a bet that the stock is going to go up in the form of a contract. A put is a contract that's pretty much a bet that the stock is going to go down. So if I say I'm leaning towards calls, that means that I'm trying to make a bet on the stock going up. If I say I'm leaning towards puts, or I'm setting up a put, that means I'm trying to make a bet that the stock is going down. So if you ever have a question on how people are making money if the stock goes up or down, they make money. You can make money either way by playing calls or puts. All right. Each contract is attached to 100 shares of the underlying stock, which means, again, if you wanted to exercise these, which I don't think no one wants to exercise any contracts right now, but if you wanted to exercise the contract, you can get 100 shares of the stock that is attached to. So we're looking at Microsoft. Microsoft is $423. And let's say one day you had the bright idea that you wanted to buy 100 shares of Microsoft, but you didn't want to buy them at 423. You wanted to buy them, at a better price later on. Then you can go ahead and grab, let's say if you wanted to buy them at 450 in 2 years, right? You could buy the contract, set the expiration for 2 years down, out the way, and then, of course, Microsoft should be more than 450 in 2 years. So you'll set that contract up. You'll buy it at 423. And once it goes above 450, you have the option to exercise the contract and take the shares at that time, or you can wait until it gets closer to expiration to let it go up even more and then exercise the contract. Then if you don't want to exercise the contract at that point, you don't have to. You can just sell it. So with options, I think that's why they call them options. It's because you can do a lot of different things with them. So again, if you bought an option contract, and most people just use them as bets. Most people just use options as bets. We look at Microsoft. Microsoft is at 423. Earlier, I charted it out. It looks like it's going for 430 to 440. So that means if Microsoft is going to 430 to 440, that means you would set up a call, because a call is a bet that the stock is going to go up. And then you'll have to pick your strike, expiration date, so on and so forth, to set that call up, and then pick a point to get out. That's one of the easiest ways to explain an option. I can explain it in a different way if someone's confused. And I know a few of you, Ty, I think Lisa, Michelle, have already talked to me about options before. Nisha, do you have any questions? And if you're completely lost, that's fine.
I'm good.
Well, okay, perfect. We're all on the same board. All right, let's keep going. So I have to slow down. All right, next thing. 3 features of an option. So we have strike, expiration, option premium, right? So a strike price, let's go to, we actually have this in TradingView now, I want to say. Oh, I did not mean to do that. Where are we at? Trading panel, paper trading. Let's see if my paper trade will work this time. Trade, and we're looking at Microsoft. All right, perfect. All right, so is it going to let me do options? Can you do options here? All right, I haven't figured this one out yet. So we'll do the, we can go to Investopedia and look at options. Actually, we can do the option profit calculator. I think that'd be easier to explain strikes and things of that nature. All right. So again, we're going to be talking about strike price. This is the price at which an option can be exercised. So a strike price is just pretty much the price that you want the stock to go to. So if we're looking at Microsoft, and again, I said that Microsoft is at 423, and we can see Microsoft going to 430 to 440. What you would do is you want to buy a call option, right? So you can buy or write. The only difference between buy and write is that buy is buy, but write actually means sell. We're not going to talk about that yet. We'll talk about that in a few weeks. But buy, we want to buy an option. And so when you buy an option, they're going to ask you to pick a strike. So your strike is right here in the middle. Your strike is the price that you want the stock to go to in this case. So in this case, we say that Microsoft, again, is going to 430 to 440, in somewhere in between. We need to chart it out a little bit more. But let's say Microsoft is going to 430, right? So that's what your strike is. Your strike is the point that you think that the stock is going to go to. So when you're looking at puts, when you're looking at a bet that the stock is going to go down, normally your strike is going to be a price that the stock is that you think the stock is going to go down to. So right now, Microsoft is at 423. And let's say if we looked at the chart and we decided that Microsoft is going down, then we would be looking at puts. And when we look at a put, the strike that we would pick would be lower than the actual price. So we thought that Microsoft was going down from 423, let's say to 400. We may pick our strike at 400 or lower, right? As an example. So again, strike is really simple, just the price you think that the stock is going to. Next thing is expiration date. So once you have a strike in mind, you also need the date that you want to pick that the contract is going to expire on. Now, a lot of people get hung up on expiration dates because they either pick them too close or they pick them too far out to where they become impatient and they exit the trade too early. So when you're picking your expiration, it's always good to pay attention to what time frame you're looking at or what time frame. If I chart it out, you can always ask me, let me minimize this. If I chart something out, if I chart something out, you can say, okay, what time frame was it on? All right. So if I chart something out on the daily time frame, the expiration dates that I'm going to be looking at is going to be weekly, right? So if I chart something out on the day, I'm looking at 1 week, 2 week, 3 week expiration dates. If I chart something out on the weekly, then my expiration dates are going to be a month and a half, 2 months out. The reason why I'm saying that that my expiration dates are going to be set like that is because you need more time. So if I chart something out on the weekly, that means that it's going to take weeks at a time for the play to actually set up and function. If I chart out something on the daily chart, that means that it may just take a few days for the stock to do whatever it needs to do, and then I need to go ahead and take my money and run. So that's why I say when people are picking strikes, make sure you understand where you charted the stock out at. If you charted on the daily, you should not be picking a contract that expires in the middle of 2025. That's too far out. You need to be looking at weekly, monthly if you're picking that far out. But if you're looking at the daily and you say, okay, I want to take this trade, it looks good on the day, then you need to be looking at 1 week, 2 week, 3 week expirations. And the shorter the time, the more risky it is. So I always tell people, add more time than you think. So if you look at a trade on the day and you say, okay, well, this could happen in about 4 or 5 days, right? Get about 2 weeks. If you think that something is going to happen in a week, do not buy a week expiration. Because it's been times where when I first started trading options, I was right, but I lost money because of the expiration date. So the closer you get to the expiration date, the more the contract is going to start to expire. You have time decay. So in the next few weeks, we'll be talking about the Greeks that are attached to option contracts, and they make the option function differently depending on time. And one of the key ones is called time decay. It's called your theta. Time decay means that once you pick that expiration date, the clock is ticking. And every day that the stock doesn't move towards the price, you're going to be losing money. So it's a little bit more to it, but to keep it simple, that's what you're basically picking against. So when you're looking at buying these contracts, again, add a little bit more time to it. Yeah, the earnings may be slowed, but that's okay, especially if you're just into trading options. If you've been trading options for a while, you probably know what you're doing. You can pick shorter expiration dates. You know how to get in and get out. But if you just started, set out more than enough time. So if you're looking at a week, set out 2 or 3 weeks. just to give the play time to actually work to where it's not moving too fast, and then you can go ahead and take profit. So if we're looking at Microsoft as an example, again, as far as strikes, right now it's at 423. If we're looking at a strike, we're going to say 430, right? We want a 430 strike, but look at these times, right? So we got the 13th of September, which is too close. And then we have the 20th and the 27th. So what I would be looking at is, and then we have the 4th of October, sorry. What I would be looking at is the 27th and the 4th of October for this trade. So if I'm looking at,
LJ, question: why did you pick 430, and why did you pick the dates that you're picking?
Yeah, so the reason that I picked 430 is because when I look at the chart, I can see that this line right here, this blue line, this resistance at 430, it frequents a lot. And it looks like that we could get back up to this 430 line. So if I set my strike at 430, it doesn't have to hit 430. It just needs to approach 430. So if it's right now, it's approaching 430. It's already at 423. $7 more, we're at 430. And it could go way past 430. It could break 430 and start to head towards 440. But I think 430 is the safer bet. It's easier to get in the money in that case. Does that answer your question, Ty? Well, wait, you had you had two questions. Why did I pick that strike, and what was the other one?
And the other was, why did you pick the date? And then the other thing too is that, like, the option that I did, like with your support, it, because of the fees associated with the option, it increases the price, the strike price. That's what I think.
It increases the strike.
Right? Yeah, like
strike
it
price
actually, like it has to go, because I think we picked something like 425, but I have to be above 425 in order to be in profit or in the money.
Right. Yeah. That's true. Yeah, that's for your setup. But you got to also remember your expiration is not until 2025.
Yeah. Yes.
So like the metrics that make up your option is different from this one that we're looking at. This one is short dated and it expires in October. Yours would have 90 to 120 more days, added to it. So yours is going to function a little differently, and it's going to move at a slower pace, meaning it'll move slower to the downside and upside. But once you get in the money, since your strike is 425, once you get in the money, then it's going to start to rapidly increase.
So I understand, like, you picked 430 because that's the resistance, but why did you pick the dates that you picked?
Yeah, so I picked the dates of 2 or 3 weeks because I think that we can get to 430 in about a week. So I wouldn't pick 430 with an expiration date of this week. Like, we only have a few more days left in this. What's today? Wednesday. We have 2 more days left in this week. We could hit 430 by Friday. I mean, it moved $8 today, almost $9 today in one day. So it could move $7, or it could move, $5 tomorrow and $5 the next day. That will place us at 430. But I want to be safe. So this is how you play it safe with short dated options. So I'm adding the 2 weeks. I think this is going to happen in a week, but I'm adding the 2 weeks just in case I'm wrong. So anytime you're playing options, you always have to think about that. If you're wrong, it shouldn't cost you the whole trade. If you're wrong, it should only cost you 10, maybe 20% of the trade, and then you can exit. Does that help, Ty?
Yes.
All right, cool. Any other questions? Great questions, Ty. All right, cool. Silence means keep going. All right, so again, we're looking at a 430 strike. We want to pick either the 27th or the 4th. We can look at the 27th, and then we can look at the price. So this will come down to, okay, how much are you willing to spend at this point? Right? So the further out the date, the more the contract is going to cost, because you pay for safety in the stock market. The safer it is, the more likely you are to make money. So it's going to cost more. All right, so if we look at the 27th of September and we look at a 430 call, we can see right here is 5.53. So let's pick that one. So 5.53 is not $5.53. That's actually $553. The reason why you have that 5.53 is because the contracts are multiplied by 100. The reason why they're multiplied by 100 is because the contract is attached collaterally to 100 shares of the stock. You don't have to pay for 100 shares of the stock, but whoever wrote this contract that you're buying, they had to pretty much have 100 shares of the stock to sell this contract to you. That's pretty much the shortcut way of what's going on. So the contract costs $553. We're sending it out to the 27th of September, and we have a 4:30 call. Again, the stock could be 4:30 tomorrow, or we have a major report coming out tomorrow for inflation. Could be 4:30 tomorrow, could be 4:30 Friday, or it could go back down to 4:20 tomorrow and then jump back up to 4:25 on Friday, so on and so forth. That's why you want to play the protection game, because it doesn't always have to go your way immediately. You might buy a contract and then the first day you buy it, you're down, but then the rest of the days you're up. So you don't want to move too quick when buying these contracts. But back to what we're picking. So we have a strike. So this is your strike right here. Your strike is 4:30. Your expiration date is right here, September 27th. And then the type of option contract is right here. We have a call. So if you're in the Discord and you see me post that I'm in Microsoft 4:30 calls expiring September 27th, this is what it means. It means that I've purchased a call that expires on the 27th of September and a strike of 4:30. All right. So again, total cost is 553. We can go ahead and calculate. Let's change this to profit loss. All right. So you have most platforms have a profit loss calculator built in. I know, most of the platforms that I can think of off the top of my head have some type of profit loss calculator, but this pretty much tells you the money that you could make if implied volatility stays the same. If you don't know what implied volatility is, don't worry. We'll talk about it in later sessions. Again, this is just the intro to options. And this is just the first week, but this is telling us like, hey, currently the stock is at 423. Let's say it jumped up to 430 tomorrow, right? If it jumped up to 430 tomorrow, you can look at this little blue box right here. If it jumped up to 430 tomorrow, the total price of the contract would be $877, meaning that we made 324. So if tomorrow this was to go up $6 or $7 up to 430, we'll be making $300. So when you're setting up your contracts, this is why picking great stocks or great setup on stocks is going to become a thing that you have to do when you're picking options. Because if you pick an option that eventually is going to move, that's fine, but it's harder to play a option play on it. Options are time based, so you have to be ready to say, okay, this stock should be at this price in this amount of time, right? So if it's at 423 now, we're betting on it being at 430 before the 27th of September. That's pretty much what we're looking at. And that bet cost us $553. And again, if it goes up to 430, let's say tomorrow, then we can make 330 bucks, I want to say. Any questions so far? Cool. Keep it moving. All right. Option premium is just the price at which the option was purchased, which I just covered that. Let's talk about puts. So we talked about calls, right? We talked about a bet that the stock is going to go up. Easy. Let's look at puts. Let's look at a setup for puts. So we look at Apple. I want to say Apple on the weekly should have a put set up. Yep. Boom. All right. So we're going to walk through the same process, but this time we're looking at a stock that we're thinking is going to go down. All right. RSI is at 61. It's pointing down. Apple has pretty much been trading sideways for a while. It's been bumping up against this top level at 230, and it's been pulling back. So it's been between 230 and 215. And then when we look at the MACD, this is your trend indicator again. So it's been in an uptrend, but right now it looks like it's about to go in the downtrend. We have a pending MACD crossover to the downside. So anytime the MACD crosses over, we know that, okay, it crosses over to the other side. That means that the trend has changed. So that means we'll be in a downtrend if this blue line goes under the red line. And then if we look at the stochastics, we can see that it's already pretty low at 20. But if we get that MACD crossover, then we can flush it all the way back down to 0. So this looks like a good stock to play a put on. Again, pending MACD crossover to the downside, RSI is pulling back, stochastics is pretty low, and we still have space for this to come down to about 211, 210 to touch the top of its 20 MA. Let me zoom in some to touch the top of that 20 MA. So this is just what I'm looking at without, again, this is not doing, multi-time frame analysis. I'm not adding in any other factors. I'm just looking at this saying, hey, for this example, this stock looks like it could be going down. So how do we make a play on it? And again, a put is a bet that is going down. So we have to flip everything upside down. The only thing that's not flipped upside down is the expiration date. All right, let's walk through this one. All right, now, same thing, buy or write. Matter of fact, I want you all to answer. Someone tell me, are we buying a put contract or are we writing a put contract? It's a trick question.
We're buying one.
Perfect. Yep. So a lot of people get confused with puts when it comes to buy, and sometimes in your platform it may say sell. It's still you still are doing a covered form of a call or put if you're writing something. If you're buying something, that's all you should be doing. So if you're a beginner, just buy calls, buy puts. I think that's the easiest way to go. So we're buying a put. So we look at puts. You'll notice that this is separated by two sides. You have the call side, and then you have the put side. I'm not going to go into too much into in the money and out the money, intrinsic, extrinsic, because we'll be talking about that, I want to say next week. And then I have a whole reasoning behind that, a whole display behind that. Right now, I just wanted to give you all the basics. All right, so we're looking at puts. Same thing. What is our strike? So if we look at Apple, we see the Apple is at 222. What I would do if I'm looking at puts is look at my support. So if we set our call on resistance, which was the point that we thought that the stock was going to go up to, we need to set our put on support, right? So we have two options. Oh, sorry. We have two options. We have 215. We also have 207. Actually, we have three options. We got 215, 207, or we can do the top of this 20-week moving average at 211 to 210, which is right in the middle. So what I would do here is I would just err on the side of caution. I would go with the top of this moving average versus this floor here, because we could bounce off of this moving average first. But you can see that clearly this is a good floor forward. But if you just want to be a little conservative, I would go with that top. So we're looking at about 210 on a strike. So that means that we're thinking that, again, this is on the weekly. We're thinking that in a few weeks, this could be pulling back down to 210. Again, we already checked all the indicators that told us so. So we're looking at a strike on puts. We're looking at a 210 strike, right? So 210 is our strike because that's where we think that the stock is headed. Anytime you think about the word strike, where is the stock heading? So if you're doing calls, the strike should be up. If you're doing puts, the strike should be down. So we're doing a 210 strike, same time frame, September 27th to the 4th. Oh, no. I'm sorry. We're looking at the weekly. So we're looking at the weekly. That means that you want to give it a bit more time. When we looked at Microsoft, we looked at it on the day. This example is on the week. So on the day, the 27th to the 4th, perfectly fine. If you're looking at the week, you at least want to go to the 4th and you may go to the 18th or further, right? So 4th minimum, but you could do, again, 18th. You could go into December if you wanted to. But for this example, we'll do the 11th of October. It's my mom's birthday. So we'll do 11th of October, and we'll look at the 210 call. The 210 put. So 210 is our strike. And we can see right here, we're going to select it. So this is telling us that what we're doing, we're buying a 210 strike for a put that expires on the 11th of October. The price for the contract is $199, which is $199, right? Just move the decimal over again, because we're looking at a multiplication factor of 100, right? So it's $200 for this put. Calculate, and then the last time we looked at the profit loss, you saw green was on the upside. This time you're going to see green to the south of the chart, because we want the stock to go down. So again, this is how people make money when the market is crashing. So every time you hear, oh, the market is crashing, some people want the market to crash because they're probably in puts. They're probably holding puts on stocks that, or holding puts up against indexes as far as the SPY, the Qs, so on and so forth. But all right, let's continue with this example. 222, we said that it could go down to 210. If we look down at 210 for the 14th, my little blue box here, we can bring it right here in the middle. We can see that the price total would jump to $548, meaning that we made $349. So we would have paid $200, and we would have came out with 548 for a profit of pretty much 350. That's if it happened in that day. Now, if it didn't happen in that day, let's say, since we looked at it on the weekly, let's say it did drop down to 210, but it took a second. Let's say it took to, the 3rd week in September. And now we're looking at a profit of 408. So you put in 200, you came out with about 400. You made a profit of 209 if it drops to the downside. So this shows the strength of picking your strikes. Picking your strikes and picking the dates is pretty much the whole makeup of how you buy your contracts. And again, all of that information you're going to get from your chart. And if you need help, you can just let me know. Hey, this is what I'm looking at. Am I looking at this in the right way? And it's not as hard as it looks for my newer people. It may look a little confusing, but as soon as you try it, you get into it. You set your strike, you set your price. You don't have to buy anything. You can, if you're in a Discord, you can send it over to me. I can take a look. But this is how puts work. People bet against stocks all the time. So if you're on the internet, or if you're in the Discord, you may see people happy for your stock, or you might see people mad that your stock went up because they may have bought puts when you bought calls. But that's how you would set up a put. Do I have any questions so far? Oh, let's drop my phone. Any questions on put contracts? Cool. Silence is a thumbs up. All right, let me make sure there's nothing else here. Oh, pretty simple and straightforward. All right. Again, if you wanted to read the rest of this, it also breaks into short squeezes. If you want to get into short sellers and short squeezes and things of that nature, you can. I do not recommend playing shorts. I don't. There's an unlimited amount of money that you could lose when playing shorts. Playing a short squeeze is different than playing a short. I don't short stocks. A lot of people think short stocks should be illegal. It's not illegal, but the way that it works is just too risky for the reward, in my opinion. All right. Let's go into the basics. Oh, yep. This is another. Oh, let's talk about expiration dates again in this sense. So a lot of people like to ask, if everything goes well, you make money, you sell the option contract. Your goal, I don't care if you're playing calls or puts, your goal is to sell this contract before the expiration. Remember, if we're looking at this put And this put, we said that what, the $400 would have came from the middle of September. We still have until the end of October as far as expiration. I mean the 11th of October as far as expiration, but you do not want that to happen. Once you hit your target as far as profit, leave. Normally what I do, if I'm looking at options, depending on how long I put my my expiration date out, it helps me pick on how I want to set my percentage target. Normally, if I have a far away date, I'm looking at 30 to 50% profit. So if I'm looking at something on a weekly and I set it out into, you know, a month and a half, 2 months, I'm looking at 30 to 50% profit. Now, if I'm looking at something shorter, then I may be looking at 20 to 30% in profit. Sometimes I'll even take 10. If the market is really volatile, we have Jerome Powell speaking, we have holidays coming up, so on and so forth. Profit is profit to me. 10%. If I'm looking at, I wake up, my stock shoots up that morning and it's up 10%, and I'm thinking like, it's a rocky day, I'm going to go ahead and take that 10%. A lot of people lose money by just leaving money on the table. Make sure you have a percentage target in your mind set before you pick any of these things. Calls, puts, it doesn't matter. When you go into the trade, make sure you know, okay, 20% is my number. 10%, 30% is my number. And the lower the percentage, the more likely you are to hit. So if you're aiming at 10% per trade, you're probably going to hit that more often than you will be hitting 50 to 100% on each trade. Some people are aiming for 100% on every trade. That's not going to happen. It just doesn't work that way. Can you get 100% on a lot of trades? Sure, I have. But did I get 100% on every single trade? No. But aiming for 10%, let's say if you trade every day for a week, right? That's 50% in 1 week. And it's happening at a slow pace to where you can control it and you can pay attention to what's happening. So make sure, again, you set your target. If you knew, again, I'm saying 10 to 20% on options. If you've been trading them for a second, then cool, go up to 30%. You can do 30 to 50. And after that, you can do it how you want to do it. Once it comes to day trades and scalps, that's a whole nother ball game. Even scalpers may do 10% to 15% because it's safe. Ty?
I have a question. Would you do an option on NVIDIA right now, given that there's a lot of movement?
Let's take a look. Ooh. Yeah, I would. Oh, yeah, I would. Yeah. But I would need
Okay, but to the upside or to the downside?
upside. I would need the upside.
You would go
But
upside. I sold some shares today. Ugh. Okay.
yeah, I would look at the upside. But again, the condition that I need is 120.
Lisa's laughing at me right now. Like she can't stop laughing.
Yeah, Ty, you buy and sell on the you sell when you need to buy, you buy when you need to sell sometimes.
Oh
But it's
my God.
okay.
No, I didn't touch my long-term shares. Those I still hold on through everything. These are my short-term shares.
Right. It's okay. You're trying to
And I said profits, like somebody said to do.
I don't know who told you that one. But no, it's not. Again, as long as you're not losing money, it's all good. It is a-okay. If you take profit, that's another thing. Never feel bad about taking profit, too early. As long as you don't lose anything, we all win. I don't care if it's 5%, 7%, 8%, whatever. Profit is profit. But looking at this stock, and knowing how it moves, I need this to be above 120. Right now it's at 17. It moved up 8% on the day. Today would have been a nice day to trade it. But since I wasn't watching it today, I didn't know. Yeah, today would have definitely been a nice day. So if you was watching this yesterday, what you could have saw, let me see if I can we do a replay. Where's the MACD? So I'm doing a replay. You can see the MACD forming this crossover, right? And then, yep, boom, it had the crossover. So yeah, the MACD crossover from yesterday would have gave you that on the 4 hour, which would have gave you the 8% move today. That would have been nice. Now, since we're here today, I would need 120 or higher because this could reject off of this moving average around 117 to 118. It's two moving averages that are crossed right here. So if it pulls back, then it could pull back to about 110 to 113 and then try to go back up. So for me to trade this, I need 120 or higher, which it looks like it could already be there. We can see that the RSI is already curving up. It's at 51. We like 45 to 55 pointing up. You also see that the MACD is heading for a crossover, and we just had one on the 4 hour. And then you can also see that the stochastics is curling up. So everything is curling up and could get ready for another pop to about 130. But I need 120. Does that help, Ty?
Yeah, I think my rationale was because this was such a big pop. I just thought, let me just secure some of the profits, you know?
Oh no, you're right about that. That's a good move.
Because it's like 8% is huge for Nvidia.
Yeah,
It's huge.
one day.
Huge pop.
Yeah.
Yeah, so I just thought, you know what, in case it consolidates or there's a little bit of profit taking. But I mean, today was a perfect trading day in that it's just solidly kind of bullish, right? Slow and bullish throughout the whole day.
Yep.
It was like it was a really nice chart today.
Yep.
And I sold it off at 7.5.
Nice.
So like just because I didn't know it would, I thought that resistance was 116. So I sold at about 115.75, and then it continued to run. And I was okay with that because it's hard to get the top. And I was like, you know what, I'm going to take profits and I'm going to try to get out, sort of like at the top end, but
Yep.
not try to get every single penny.
Yep, you did right. Yeah, you got out. Yeah, again, since you were already in it, you got out at a good point since it was at a high today. Are we going to see 8% tomorrow? Probably not.
No, we can't see 8%. That would be crazy.
Right. Yeah. So again, you made a good call. Another thing that I wanted to point out before we go, because we're a little bit over time, but that's cool. They have dividends coming out, right? So anytime you have a dividend coming out, you want to be careful because this dividend payout is what the stock could go down by. This is, I mean, their dividend payout is like 1 penny. So it's like, or 10 cents. So it really doesn't matter, but it could start a pullback, right? So you taking profit today was good. I don't know if you knew that they had the dividend payout tomorrow, but no, not the, I got it backwards. I'm saying the dividend payout. This is not the payout goes on the 3rd. This is the X date. So the X date is the day you need to be in the stock to qualify for the payout. But same thing.
So if I sold it today, do I still get the dividend payout?
Nope.
Oh wow. Well, who cares? What's the point of them giving a dividend anyways? It's a penny.
Well, it wasn't a penny before the split. And so, yeah, I actually got that backwards. You actually do qualify. So after tomorrow, you don't qualify. It's the cutoff date. Okay. I'm getting all my dividend information backwards. But yeah, so you qualify for the dividend. After tomorrow, you wouldn't.
Okay.
But the dividend wasn't this small before. At one point, the dividend was like 50 cents per share, but that was before all the splits and things like that. Now that it's been split so much, the dividend really doesn't matter.
Okay. Thank you.
No problem. All right, cool. I think we are at time. Give me 1 second. Let me stop this recording. Man, the time flew today.